So recently, Straits Times released a list of the 10 top dividend-paying ETFs on SGX, and the yields look very juicy. But of course, just because a yield is high doesn't always mean that it is a good investment. That's why in this video, I want to go through these top 10 ETFs to see what they actually do, how much they charge in fees, and their long-term potential. Then I will also give each of them a ranking from the elite tier, good tier, meh tier, and avoid completely tier. And as always, this is not financial advice and is for educational purposes only, yeah? So with that being said, let's jump to the first two names on the list. The Spider Straits Times Index ETF, ticker symbol ES3, and the Amova Singapore STI ETF, ticker symbol G3B, or formerly known as Nikko AM Singapore STI ETF. These two funds are the flagship ETFs of the Singapore market, and they represent the top 30 Singapore blue chip names. Now, because both funds track the same index, their holdings are almost identical. The three local banks dominate the index. DBS alone accounts for roughly 25% of the entire weighting, with OCBC and UOB making up another major portion on top of that. The rest of the index is filled with familiar names like Singtel, Keppel, Jardine Matheson, and SGX. Given the underlying portfolio is the same, it's no surprise that the performance is also nearly identical. Over the past decade, both ETFs have delivered around 8.6% annualized returns, with dividend yields hovering around 4%. The only notable difference between the two lies in their expense ratios. ES3 currently charges 0.28% per year, while G3B charges 0.24%. However, this difference is minimal and is unlikely to have any meaningful impacts over the long term. What I like most about STI ETFs is their simplicity. With just one fund, you gain exposure to the major pillars of Singapore's economy, from financials to telecommunications to industrials. You also get a long track record of dividends that have been not just steady, but gradually rising over the years, supported by the strong profitability of Singapore's largest companies. But there are also two big drawbacks. The first one is concentration risk. With close to 50% of the entire index tied to just the three local banks, that means your dividend stream is heavily influenced by a single sector and by Singapore's credit conditions. So when the loan growth slows down or when net interest margins compress, the bank earnings can drop, and this can heavily affect the entire index. The second issue is that Singapore is a small and mature market. All the companies are mostly stable that do not have the same long-term growth potential as global equities. So if STI ETF is your only equity exposure, you are taking on a large amount of country concentration risk for a return profile that is modest as compared to broader global index funds. Because of that, I will place both STI ETFs in the good tier. They are strong and dependable, but not quite broad or fast-growing enough to reach the elite tier status. Quick pause. If you are looking for a broker to trade Singapore stocks, you can check out Longbridge. For new users, your first 90 days of trading on Longbridge are essentially free at $0 commission and 0% platform fees. And even after those 90 days are over, Longbridge continues to be one of the lowest cost brokers in the market. For SGX trades, the platform fee is only 0.03%, with the minimum starting from just 99 cents per order. Longbridge also supports odd lot trading on SGX. This means you don't need to buy a full bought lot just to get full exposure to your favorite companies. Instead, you can accumulate your positions more gradually while dollar cost averaging at a more comfortable pace. Not just that, new users can earn a 5% interest booster for 365 days on up to $5,000 deposited into any of the Cash Plus funds. And the more you deposit, the more you unlock up to $1,520 in total rewards. To make things more fun, I'm also partnering with Longbridge to run a giveaway. We will be giving out 3 Awfully Chocolate gift boxes. All you need to do is sign up using my link by 15 December 2025, and I will randomly pick 3 lucky winners. With that being said, let's get back to the video. Next up, we have the two S-REIT ETFs, the Lion-Phillip S-REIT ETF, ticker symbol CLR, and the CSOP IH S-REIT Leaders ETF, SRT. Both of these funds aim to give you broad exposure to the Singapore-listed REITs, and together they cover most of the major S-REIT names that investors are already familiar with. With these ETFs, you get to invest in names like CapitaLand Integrated Commercial Trust, CapitaLand Ascendas REIT, Mapletree Logistics Trust, and Fraser Centrepoint Trust, along with many other established S-REITs that dominate the Singapore property landscape. And because both ETFs mostly hold the same S-REITs with similar allocation, their performance is almost identical. Over the past 3 years, they have roughly delivered 4% in average annual returns, while the dividend yield sits at around 5.5%. Their fees are also similar, with expense ratios at 0.6% per year. Similar to the STI ETFs, what I like about the S-REIT ETFs is the instant diversification. Instead of having to figure out which individual REITs to buy, these ETFs give you exposure to an entire basket of high-quality properties, whether it is shopping malls, business parks, warehouses, logistics hubs, or data centers. And because the income is backed by rental cash flow, their distributions tend to be very steady and predictable. But again, the main drawback here is sector concentration risk. When you buy an S-REIT ETF, you are betting on the Singapore's property market and on the interest rate cycle. REITs are sensitive to borrowing costs, and when interest rates rise quickly, refinancing can become more expensive and valuations will tend to weaken. This can lead to distribution cuts or slower distribution growth, which we have seen over the past few years. However, while there's also country concentration risk, Singapore's REIT market is one of the most established in the region, with some of the highest distribution yields globally and historically lower volatility compared to other markets. So for investors who want a stable passive income, the S-REITs are actually one of the best options available. Because of this, I would place the S-REIT ETFs in the good tier. They are solid and reliable income investments, but they should still be complemented by broader global equities to balance out the interest rate sensitivity across market cycles. Next, we have the Amova-Straits Trading Asia ex-Japan REIT ETF, ticker symbol CFA. Unlike the previous S-REIT ETFs, which focus entirely on Singapore, this fund expands its holdings to include REITs across the broader Asia region, excluding Japan. With this ETF, you are getting exposure to names like the Link REIT in Hong Kong and India's Embassy Office Parks REIT. Essentially, instead of just the Singapore REIT story, you are getting the much wider Asia REIT story, which naturally brings a more diversified mix of property markets and economic drivers. Now, despite having more diversified holdings across Asia, this ETF has delivered a fairly similar return to the S-REIT ETFs over the past 5 years. Its average annual performance is around -1% to the 1% range, while distribution yields remain healthy at around 5.5%. The expense ratio is also roughly in line with the other REIT ETFs at about 0.55% per year. The biggest advantage of this ETF is that it gives you diversification outside of Singapore. This gives you exposure to markets that may be in different phases of the property cycle. For instance, the recovery in Hong Kong's retail sector or the continued expansion of India's commercial REIT market as their tech hubs grow. However, going regional also means taking on new layers of risk. For example, currency fluctuations can become more pronounced because distributions are earned in multiple Asian currencies before eventually being converted into SGD. This can cause your payouts to vary from year to year, even if the underlying REITs may perform consistently. Then, there are also differences in regulation, market transparency, and corporate governance. Some markets are highly developed, while the others are still maturing. This can introduce additional uncertainty, especially during periods of stress. For example, sentiments in markets like Hong Kong, China, or India can swing wildly, which may translate into short-term volatility. With that in mind, I would place the CFA ETF in the good tier, right beside the S-REIT ETFs. This ETF does a good job of adding geographical diversification and giving you exposure to growth opportunities beyond Singapore, but it also brings along a higher level of complexity and risk. Next, we have the Phillip SG's Apac Dividend Leaders REIT ETF, ticker symbol BYJ. Similar to the previous ETF, this fund also tracks a basket of high dividend paying REITs across the Asia-Pacific region, excluding Japan. One of its key differences is the way it selects and weights its holdings. Instead of weighing REITs by market capitalization, it weights them based on the dividend strength. Because of this approach, the ETF leans more heavily towards REITs that have higher historical distributions, regardless of size. Another major difference is cost. While the previous 3 REIT ETFs I mentioned all charge in the 0.55% to 0.6% range, BYJ charges an extremely high 1.64% expense ratio. That is almost 3 times the cost of its peers. and it immediately puts the ETF at a disadvantage from a long-term compounding perspective. Interestingly, despite the higher fees, the ETF has performed more or less in line with the other REIT ETFs in recent years. Its dividend yield is slightly lower at around 4.2%. However, the real issue is not the lower yield today, but the drag caused by high fees over a longer period of time. What I like about this ETF is that it provides broader Apac REIT exposure. It includes markets that many Singapore investors rarely look at, such as Australia's large and mature REIT sector and Hong Kong's established property trusts. However, the drawbacks here are hard to ignore. The most obvious one is the huge expense ratio. Where your fees is already close to 1.6%, this can erode your returns over the long term. On top of that, the ETF is extremely small in size. While the Lion-Phillip S-REIT ETF has over $700 million in assets under management, this ETF sits at just $7.9 million. With such a small AUM, its bid-ask spreads tend to be wider and trading is less efficient. Not only that, the fund is also more vulnerable to being closed down, since industry guidelines generally suggest that an ETF should have at least $50 million in AUM to be considered sustainable. But right now, this ETF sits well below that threshold. Because of these issues, I will place this ETF in the avoid tier. It's not that the strategy is flawed, but the combination of high fees, small fund size, and the ongoing risk of closure makes it hard to invest in, especially when there are better, cheaper, and more stable alternatives offering similar regional REIT exposure. Next, we have one of the more unique ETFs on this list, the Lion-OCBC Securities SG Low Carbon Index ETF, ticker symbol ESG. Unlike the typical Singapore equity ETF that simply tracks the STI, this fund selects and weights Singapore companies based on their carbon efficiency. What's interesting about this fund is that you are getting exposure to not just the usual blue chip names, but also to companies that are not in the STI, such as Sea Limited, Trip.com, Grab, and Flex. Many of these stocks have been performing strongly in recent years, and their inclusion adds a layer of growth that the traditional Singapore companies typically lack. As a result, over the past 3 years, this ETF has been one of the strongest performing funds in Singapore, outperforming even the STI ETF itself. Not only that, it also offers an attractive dividend yield of around 5.9%, which is incredibly generous for a fund that also carries meaningful growth exposure. Although, take note that a part of the yield may come from capital rather than pure dividends. The ETF charges an expense ratio of about 0.45%. While this is slightly higher than the STI ETFs, it is still very reasonable given the broader set of holdings and the growth potential that comes along with it. What I like about this ETF is that the inclusion of faster growing companies not only boosts its growth potential, but also helps to reduce the heavy reliance on banks that STI suffers from. Because of that, I will place the ESG ETF in the elite tier. Its added growth exposure makes it a strong satellite holding for long-term investors. But we will still have to see how well it performs over the next decade and whether it can consistently maintain its current advantage over the STI. Next, we have the iShares JPMorgan USD Asia Credit Bond ETF, ticker symbol N6M. With this ETF, you are getting exposure to well-established issuers across the region, including names like Petronas in Malaysia, Indonesian sovereign and quasi-sovereign bonds, major Philippine banks, and state-linked Singapore entities. In terms of return, this ETF has delivered a respectable 3 to 4% annualized return over the past decade. Its current distribution yield sits at around 5%, and its average credit rating is at BBB. This is attractive for an investment-grade bond portfolio which provides a steady income stream without taking on excessive credit risk. Its expense ratio is at 0.35%, which is reasonable for a regional fixed income ETF and does not eat too heavily into long-term returns. What I like about this ETF is that it offers a clean, diversified, and convenient way to access Asian investment-grade fixed income. For most retail investors, buying individual Asian corporate or sovereign bonds directly is either impossible or impractical. This ETF solves that by offering broad exposure in the region in one ticker, while keeping the risk profile relatively conservative. However, with that being said, if I am looking for a bond allocation that goes beyond just Singapore, I would personally choose the iShares Core Global Aggregate Bond UCITS ETF, ticker symbol AGGU. That's because AGGU offers far broader diversification across the entire world, covering global government bonds, investment-grade corporates, securitized debt, and more. has a much lower expense ratio of 0.1%, and while its 2.95% yield is slightly lower, the portfolio's average credit rating of AA makes it significantly safer. Because of that, I will place the N6M ETF in the meh tier. The risk-reward balance of the Asia Credit Bond ETF still makes it a perfectly good choice for investors who want Asian bond exposure. But for myself, I prefer AGGU's lower cost, global reach, and defensive characteristics. Next up, we have the iShares USD Asia High Yield Bond Index ETF, ticker symbol O9P. With this ETF, you are getting exposure to riskier issuers across markets such as India, China, and the Philippines. Many of these issuers come from sectors like metals and mining, gaming, electric utilities, and large retail groups, sectors that are highly cyclical. And because these companies borrow in US dollar and often need to offer higher interest rates to attract investors, the ETF is able to deliver a yield of close to 7%, which on paper looks extremely attractive for a bond fund. However, this high income comes with substantial risk. The biggest concern is credit risk. Many Asian high-yield issuers have weaker balance sheets and a significantly higher probability of default, especially in stressed economic environments. This risk is reflected in the ETF's average credit rating of BB, which places it in the junk bond category. In other words, a meaningful portion of the portfolio consists of companies that credit agencies believe have an elevated chance of running into repayment issues. On top of that, since the bonds are USD denominated, investors are also exposed to currency fluctuations between US dollar and SGD. This introduces an additional layer of volatility, which is not what most people expect when investing in bonds. Because of these reasons, I will place the O9P ETF in the avoid tier. While its yield is undeniably high, it comes with a level of risk that makes it unsuitable for most long-term portfolios, especially for investors who look to bonds for safety and stability. Finally, we have the Lion-OCBC Securities Apac Financial's Dividend Plus, ticker symbol YLD. As the name suggests, this ETF focuses entirely on the financial sector, specifically on around 30 of the largest and most established banks, insurers, and financial institutions across the Asia-Pacific region. These are institutions that often form the backbone of their respective economies, and many of them have long histories of paying consistent dividends. As of making this video, this ETF offers a yield of around 6%. In terms of performance, it has been fairly strong in recent quarters, supported by rising interest margins and steady earnings from several APAC banks. However, the expense ratio is relatively high at 0.83%, which makes it more expensive than most broad market equity ETFs, and even pricier than the REIT ETFs that we discussed earlier. Over the long run, this higher fee can reduce the overall returns. What I like about this ETF is the convenience of gaining diversified exposure to the APAC financial sector. Banks and insurers are traditionally reliable dividend payers, and having exposure across multiple Asian markets can help to reduce reliance on any single economy's banking cycle. But on the flip side, this ETF has three downsides. The first one is its higher expense ratio, which means a larger portion of its returns is constantly eaten up by the fees. Second is the dividend withholding tax. 20% of its holdings are in Japan and another 16% in South Korea. Both of these countries charge a rather high dividend withholding tax, with Japan charging 15% and South Korea charging 22%. That means another huge part of your dividends will get eaten up by fees. And lastly, there's sector concentration risk. Because this ETF holds only financial companies, your performance will be heavily influenced by interest rate movements, credit conditions, regulatory shifts, and regional economic health. So if Asia experiences a slowdown, or if banks come under pressure from bad loans or narrowing interest margins, this ETF could face heightened volatility. Because of that, I will place the YLD ETF in the meh tier. It offers solid income and decent regional exposure, but the sector concentration and higher cost limits its appeal for most investors. So there you have it. Those were the rankings of the top 10 dividend-paying ETFs in Singapore. Hope you found it useful. Like, share, and subscribe as I'll be posting new videos every week.